Hi, I'm Bob, the Mortgage Coach Mitchell, and today we're going to be talking about how much house you can afford to buy. Okay, and this is actually a very complicated topic. It's one that even a lot of loan officers and a fair number of underwriters don't completely understand. Generally speaking, the underwriters in particular, a lot of times they will be a lot more conservative than what they need to be. That they won't give you credit for the full amount that the guidelines would allow you to do. So anyway, if you're self-employed right off the bat, that's going to put you in a different category of complexity. So today we're going to focus in on folks that are employed. Now, if you're employed, okay, there's three different ways that you can get paid generally. You can get an hourly rate, you can be on salary, or you can be on commission. If you're on commission, that's going to be a lot like being self-employed. We're going to need a full generally speaking, we're going to need a 2-year history of the commissions being received. That's not all the time the case. If you're at 16 or 18 months, we might be able to make it work with that. But for the most part, if you're getting a commission income, we're going to treat you a lot like a self-employed borrower, which again is going to be a different level of complexity. Not that you can't do your deal; it's just going to be something that we're not going to be able to cover in a 5 or 6 minute video. Okay, if you're in that situation, if you reach out to me through the comments or call or whatever, and we'll talk about your particular situation. But if you're on a salary, that's actually the easiest, particularly if you can qualify on just your base salary. If your base salary is, a lot of people get paid a fairly small base salary, but then make a lot of money in bonuses or commissions. Again, that's going to put you more in the category of being a self-employed borrower. Even though technically you're employed, we still need to determine what the average effective income is going to be. Okay, so now, if you're an hourly employee, there's still some calculating that needs to be done. We need to figure out what your average number of hours worked are and what your current rate of pay is. So again, notice that I said current rate of pay. We don't have to average those. I'm fighting with an underwriter right now to where one of our borrowers got like a $6 an hour raise, and we got a paycheck stub, and we documented that he got the raise, and the underwriter's trying to average it, which means 2 years of $14 an hour versus one pay period at $20 an hour. Her average came in at like $14.10 an hour, which didn't do us a whole bunch of good. I'm 100% confident I'm going to win that battle. I might have to pull it to a different investor, but I'm confident that we're going to win that battle because it is your current rate of pay times your average number of hours worked. So the longer the average we have, the more secure that calculation is. There are guidelines. There are rules. The rule generally is one complete tax cycle. That's for self-employment and for averages on commissions and that sort of thing. But even those rules can have exceptions to them. So again, if you're getting into anything complicated, reach out to me. I'll give you an example though of two that kind of illustrate the point I'm making. I had a borrower who had won the lottery. They had elected to take the 20%, or they elected to take the payments over the 20 years. Okay, but they hadn't received their first payment yet. So we had all the documentation from the lottery commission showing what they were going to be paid and when they were going to be paid it and that sort of thing. We packaged it all up, sent it to the underwriter, and the underwriter said no. Well, we duked it out with the underwriter, with the underwriting manager, with the head of the underwriting, and the answer with that particular investor was no. So while I was fighting them, just on the odd chance that I lost, I reached out to some of my other investors, and I found one of my other underwriters had actually done a deal very similar where they had actually ran it all the way up the flagpole to Fannie Mae or HUD or whoever they ran it up to, and they came to the same conclusion that I did, that we could exclude that from the requirement of the 24-month average because it was so guaranteed by the state. The state is, if the state defaults on that obligation, then we're all going to be in a world of hurt. So eventually we were able to do that deal, even though it technically didn't meet guidelines. Okay, another one that did technically meet guidelines that I wasn't able to do was I had a lady whose income was derived from a trust. Okay, it was a 20-year trust. When her husband passed away, he gave her this trust, and she received all the benefits from it. She received all the income, which was like $300,000 a year, and she had been receiving it for 16 years. So she more than met the having been received category. Now, was it likely to continue? Yes, there was actually 4 more years that were left on that trust. However, there was no evidence of any way of her being able to generate that income without the income from the trust. And the trust was structured that at the end of the 20 years, the assets that were in the trust would be transferred to the guy's kids from a previous marriage. So even though she technically met guidelines, we weren't able to do the deal because it wasn't strong enough on a likelihood to continue. We don't want to put somebody in a position where they're going to fail. And if we had done that loan, then there was a good chance that at the end of the 4 years, when her income went from $300,000 a year down to zero, she was not going to be able to make that house payment, at least not for very long. Anyway, that illustrates the purpose that these are guidelines, not rules, and how complicated and nuanced calculating effective income is. So anyway, if there is a calculator that I'm going to include on the comment on the description below that Freddie Mac has, that where you can punch in all the numbers. And it actually works very, very well. Don't let it be the end-all be-all, because again, especially if it doesn't tell you what you want to hear, there are a host of other tricks and sleights of hand that we can use to get you into a house. But for right now, for your purposes of calculating it, what we're going to do is we're going to take if you're on an hourly basis, we're going to take your average number of hours worked times your rate of pay. We're going to divide the total payment by your effective income. That's going to come up with a ratio. We're going to want it to be less than 28%, no more than 33%. After we've calculated that amount, we're going to add to that any monthly obligations you have: child support, alimony, charge card payments, student loans, anything along those lines. We're going to add that to the monthly housing expense, and we're then going to divide that by your gross monthly income. That's going to give us your back-end ratio. We want your back-end ratio ideally to be less than 36%. 41% is generally pretty tolerable. 43% is not unusual. If you go above 43%, we're going to have some nice compensating factors. So anyway, in a nutshell, I'm done. I know I'm done. I know I'm throwing a lot at you, but if you have any questions about your particular situation, please feel free to reach out to me. What might take me a minute or two on the phone with you, to answer your questions is not going to hurt me. And, if it helps you, then that's all the better. So I'm Bob, the Mortgage Coach Mitchell. I really appreciate you tuning in. This is a good topic. I hope it catches your interest. If you know anybody who's in this situation where they're thinking about and wondering how much house that they can afford to buy, feel free to share the video with them. Also, if you would, like the video and subscribe to the channel. That really, 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 really helps. And I would truly, sincerely appreciate it if you were to do so. So anyway, I'm Bob, the Mortgage Coach Mitchell. Now let's put you into a house.